All right, good evening, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for March 8th, 2024. Um, as usual, our nightly strategy podcast, the normal review of the reports and whatnot, happens at 9:30 on Fridays, Central Standard Time. Monday through Thursday, that goes at 8:30. But Friday nights, because of soccer practice, it usually goes an hour later. So the only specific question that I had from the foundation students for tonight was from Brian Lancaster, and so we'll just jump right into that. Um, yeah, so this is his question here. On the majority of the significant moves, the RL30, that's the 30 period moving regression line, which we think of as the health of the trend, will completely cross to the other side of the dragon before the second move, before the second leg of a move is complete. And it tends to be in the process of crossing through the dragon at the end of the first leg, the beginning of the second leg. He's interested in my explanation. What is driving that mathematically and emotionally? And if indeed I'm thinking of this with the correct mindset. Is the RL30 crossing above the dragon in this instance significant, essentially? Well, it's a good insight. It's actually pretty nuanced. So just to review the bidding and to equip John, our guest tonight, with what's going on. If we have a 10 bars of price action, something like that, we represent the price as the regression line. So you take the regression line of that 10 period and it produces a 10 period regression line. That's this. I'm going to represent that as the blue line for right now. And what that represents is the best fit line for those 10 data points. And furthermore, it's anchored in the last price, the last price bar. And what that dot represents, the end of that price point, you should think of as the perfect price given the context. In this case, the context is the previous 10 bars. So in this case, it includes the bar that we're in. So if we went back 3, 4, 5, 6, 7, 8, 9, 10. That 10 period regression line would look like this. So it's a straight line. And what that does, and that yellow dot represents, given all of that price action, when you draw that line, the end point says that if there was a black box down here that was generating price, there were some factors inside that, the things that move the market, they're all in that box. And we can't know what those are. But all of these variables are at work inside the black box. And what that does is it produces all of the price action that you see, all the variation and all that other stuff. So if we could make a perfect prediction based on where the next price point was going to be, then all we would do typically in regression is we just extend the line And we say, if there was no change to the underlying variables that are in this black box that are creating the price array that you see, then we would expect price to continue to be arrayed along this line. Now, the way that line is computed is by comparing the actual price data to this notional regression line here in the middle. And what it does is minimize the distance from that price action back to the regression line. So in this case, there's a certain amount of error. We think of that as the error. In this case, in number 6, that price bar straddles the line, so there's very little or no error in there at all. So when the least squares method is used, what it's trying to do is find the line through math that minimizes the amount of error from each of the other data points. So it's trying to find the line that minimizes this, the sum of all those little red lines. Check or hold. Is that clear so far? So we're going to draw a straight line regression as a simplified description of price. And then what we could do is we could actually think of for each one of those, and each one of those time periods, wherever the regression line crosses the timeline, that's sort of the perfect price for each one of those price bars. And then the actual price in this method of thinking represents an error. It's a distance away from the perfect price. And then if we were going forward, again, we would say, as long as there's no change to the underlying black box, then we would expect that line to be continuously extended until something changed with the underlying variables. Now, we know that the future performance is not going to be perfectly aligned with that perfectly drawn line. And we know that because if you go back and look at the price action, you realize there was a lot of variation in that. There was distance away from the line. So we would say, well, how good is this prediction? Well, it's not very good if you're predicting a straight line. So what we do is we find out how much error there is, and then some math is performed, and it says, now we're going to put measurements of the standard error around that prediction line. And what we would say is, because of the amount of variation that we see, we can predict in the future with some degree, some calculated amount of certainty, that we expect price to continue generally along this regression line, and then it should be contained within a certain number of errors. In this case, it works kind of like a Bollinger Band. We would say, if I want to pick a very tight range, I would pick like plus or minus 1 standard error. And then I would say, going forward, we expect the price to be contained, centered on that regression line, but then within this certain deviation away from that line. And as long as it stayed within that envelope, then we could say statistically that all of the things going on in the black box are still approximately the same. There hasn't been any change. But if we saw it break out of that envelope going forward, so now if I projected that prediction zone out, and then I noticed it was going up, it was moving along that line. So I'm sorry, I'm trying to draw this better. Hey, so 1, 2, 3 times price was within that little envelope all as well. But now suddenly price went way outside here. Something we would then say, something happened in the underlying black box. Something just happened in the black box that drove price away from that regression line. So instead of it following this one, the fact that it's outside that envelope gives us an alert that something happened. And now the truth in the market just changed. So now we would expect more variation and a new trend to develop because we have just received evidence that a significant change in the underlying market just occurred. So that's in general how a regression line is it's the best, the single line best fit for all of this price action that was, cruising along like that. So we would say, that regression line simplifies. And so what we do is rather than get confused by all the noisy price, what we do is we use the regression line as the price. We say that the regression line represents the true price and that all of the price bars represent noise. And what that simplification does is it allows us to see what's going on more clearly with the primary trend. Now, what we do is we have 4 regression lines: the 10, the 30, the 90, and the 270. And each one of these regression lines looks back that far in order to draw that straight line regression. So the 10 period regression line would look at the last 10 bars. The 30 period would look at 30 bars and so on. And we say that the trader's price is the 10 period, the trader's price. And we say that the 30 period represents the health of trend, and that the 90 represents the health of the next higher time frames trend, because it's 3 times more data, so it's the next higher trend. And then the 270, we say, represents the long-term buy and holders fair price. What that allows us to do is compare the long-term buy and holders fair price, the 270, and compare that to the fast-moving 10-period regression line, the trader's price, and that gives us a way to represent the difference of opinion between short-term traders who are bouncing around and long-term buy and holders who believe that fair value remains fairly static and that the trader's price is just noise. When the RL10 and the RL270 are at the same point, then we would say the traders and the investors both agree that that is the fair price. But if there was a big difference of opinion in there, we would say, maybe in a sideways quiet channel, the RL10 and the RL270 are both in this really tight cluster. And this price is just moving along, and they both agree that that's the fair value. There's not a trade that's available because there's no difference of opinion. But some news event then occurs, and the first thing that moves away from this congestion zone is price begins to move away, price bars. And then very quickly, because of the way math works, the RL10 quickly catches up and joins it. And now that's why because there's very little lag between the RL10 and price, we just smooth that all out and we say that the RL10 is the price. The next thing that moves is the RL30, but there's a bit of a lag because it has to it's calculating 30 price bars. So it takes a little bit longer for the RL30 to react to the price action, which is moving downward. Similarly, the RL90 is even slower to react. And then the RL270, represented by purple, is even much slower to react. What that allows us to do is, after significant directional moves, we see that the RL10 can go down this far, and then it can't go any further because everybody that was selling has sold. And now, all of a sudden, at this location, we see people come in and say, aha, we have quality on sale. We got a great symbol, and the traders have beaten the price down too much. And now suddenly I have a great asset that I can now buy on sale. And so the buyers come in, and then they start buying it back towards previous fair value. So one of the things that we will do is we take a look at the distance between the RL270 for each time period. We look at where's the RL270 and where's the RL10, and that distance, that gap between them, represents the difference of opinion between traders and investors. We can then determine, based on the size of our standard risk box, we could take a look at this turning point at the bottom of where the RL10 peaks. And because of the way it's constructed, it always comes to a sharp point because of math. So we can now express this distance from the current price down here back to the RL270, the fair value. And we could say, for instance, on a swing trade, if we were using 1 ATR as our risk box, we might say, as soon as price moves to the lowest point and then moves an ATR back in our favor, we might call that an entry, represented by a green dot. We say, I might be willing to buy this, and my hypothesis is that it could move back to the long-term fair value. And if I'm willing to risk 1 unit of risk, 1 ATR, I could now express this as how many ATRs is it from where I can enter to where I think it could go. And in this case, I have a 3-to-1 reward to risk ratio. And then I might be willing to make that trade simply on the basis of trade location. And I'm using a common unit of measure, the ATR, to measure the distance from the excursion of the RL10 away from long-term fair value. And then I express that difference as the reward. So now I can do reward to risk. Let me stop there for a second and say, check or hold. Are we good so far? Okay. Well, what if our trade actually works? Hey, that would be amazing. We get our entry here, and that thing comes back. And because the RL10 adapts to new price action much faster than the RL270, it moves up the stack of price much faster than the RL270 continues to decay. And so from the moment that I bought it, there's some meeting engagement where the declining RL270 meets the rising RL10. And when I get back to that intersection, now suddenly all of the abnormal price difference is gone. Now the traders and the investors are both in agreement that that's the proper fair price. Now, sometimes that price will overshoot, and then what you'll see is something like this. RL270 is cruising along, RL10 comes down, and then you'll see this, the RL10 comes back, and then it oscillates, and then the volatility disappears, and then a new congestion zone occurs, and now we're back into a sideways quiet channel, and everybody agrees with that new price is now the proper price. So that is the context for this question, because his question says on the majority of significant moves. Well, what made it a significant move was that and now what I'm going to do is I'm going to take a look at this chart right here. So this is a chart of this is daily charts on IYR, and this was recent. I think this is, yeah, that's today. And so if we go back about, I don't know, it's probably 90 days. There was a time when 120 days ago, IYR was up here, and then price moved down a series, and now you can see the price as these price bars. It got down to this lowest low, and then the RL10 I'm going to draw as a blue line. And I'm going to take this moment to say, what you're going to see is that this RL10 is this line right here, multicolored. That actually is representative of the MACD histogram down here. We have a strategy called our 4 seasons, which places price action within 4 seasons. So if we take the 0 line on the MACD and we say if the signal line is below the 0 line and falling, then we're going to call that the winter, because it's below the 0 line and falling. That's as bad as it gets. And price would be falling like it is over here. And in fact, and then what we do is we color code that as condition as red. And then we use that indicator to come up and color the RL10 price with the color of the season. So this is red because it's in the winter, because it's at the tail end of a big long sell-off, and the MACD is horrible. But when the MACD gets better, because price gets better, this thing rolls up and it color codes as yellow. And we call that, if this was the winter, we call this the spring, because it used to be bad, but now it's rising. It's still below the 0 line, so it's not great, but it is getting better. So we think of this turning point as winter has turned to spring. When that MACD signal line crosses the 0 line, it now becomes summer, and everything is easy until the summer peaks, and then it starts to roll over, and then summer becomes fall. And those are the 4 seasons of MACD: winter, spring, summer, and fall. And we use those 4 color codes to color code the RL10. So I'm going to now color code the RL10 so you can see it a little thicker. So this was all winter. And now you can see price started to get better. And starting right here, it became yellow. And then it continued to get better, and that was good enough to turn the MACD 4 seasons into summer. And look at this long, beautiful summer. So when we talk about price, we're actually looking at the RL10, and we're not getting distracted by all of these price bars, which you can see. Now, there was a moment in here when there was a brief moment of fall, and then fall picks up again here. And then that was enough to drive it back into the winter. And then price action began to improve and stabilize, and it became spring. And now we are in the season of fall, I'm sorry, in summer in IYR, and that's good. So right now, IYR is in really good shape. And you can see that whenever it goes for these long moves, the color code of the season turns to summer. And so one of our strategies is to try to identify these turning points when you have had a really bad winter, which turns to spring, which makes us want to buy after that turning point, right in that region. And when it crosses the PSAR, we should be long. And then pretty soon the PSAR flips, and then that becomes our routine stop until somewhere up around in here, that PSAR flips again. So we will draw a risk box to the bottom of the RL10. And so this black box right here represents the amount of risk that we have to take based on this structure. So we're entering right about here, and our initial risk is going to be right about there to the bottom of the RL10 where it turned. So when I look at this actual trade, and if I go up to where the exit would be, I can now determine that for 1 unit of risk, which was this risk box, and exiting up here when the PSAR flipped, I end up getting approximately 1, 2, 3, 4, 5, 6, 7R. That was a 7R move, meaning that it moved 7 units of reward compared to the initial 1 unit of risk. So our strategy is to try to find those symbols that we specialize in that have had the most extreme harsh winter down, because we know when that begins to correct, we are likely to get a large move up that pays us these large rewards for the given amount of risk. Check or hold. So far, so good, John and everybody? If we're so far so good, just put check in the chat. And you don't got to get all this at once, John. We record these sessions and make them available, right? Okay. Now, what made this so amazing was that when the RL 270 was up here, we had that sudden sharp move down, and that's the case where the RL 10 moved down fast and then reversed, and then we can project how far up. If this thing just returns to the previous fair value at some point in the future, how good is that potential reward against what we know the risk is going to be? And so when we look at a bunch of candidates for good trades, we try to, all other things being equal, we try to find the ones that have the best reward to risk ratio. So now let's say we've gone through that process and we found this thing down here turns out to be one of those very favorable reward to risk ratios. It's good. And it has reversed and goes through the PSAR flip. So at that location right here, I can now get my routine entry, which I'm going to color code as green. I make my little purchase right here, and then I'm going to draw my risk box in red to the bottom of the RL10, and that's going to be my unit of risk. Now I can explain what Brian's question is. The first thing I'm going to do is redraw the RL10 just in blue. I have explained why that's multicolored, but that's what the RL10 looks like on the way up. And it ends up exiting right here. Notice that the peak of the RL10 here and here, that this was a downward, this was a lower high, and then it hit the PSAR. That's evidence of this thing starting to stall in this period of time. It's stalling and running out of gas because it's not continuing to go up. It gets flat and then starts failing. If that's the RL10, which is the price, I'm now going to draw in black the RL30. Now that is the 30-period regression line. Now notice that that is a smoother curve than the RL10. The RL30, because it's a 30-period regression line, is very smooth. And whereas the RL10 has these little short, sharper moves, the RL30 is really smooth. Now, what Brian noticed is that on the significant moves, the big moves up, which follow these big moves down, there comes a moment right in here where the RL10 is starting to lag, but the RL30 crosses the dragon, which is this orange 10-period Bollinger Band. That's a noise barrier. We call that the dragon. And we see that the down here, the RL30 was way down here. And then as price gets better, it actually catches up to the dragon and crosses over the dragon. And then at the top of the trade, it's actually higher than the R10, which rolled over. So the RL30 ends up crossing the dragon right about here and then gets on the far side of the RL10, which is this line I'm going to try and draw in blue. Yeah, so this is the RL10, and it starts to run out of gas. So yes, the reason for that is that all of this noise variant, you see where I'm now highlighting price. Price is bouncing around all over the place. The more that price moves up and down, the more variation there is away from the regression line. The regression line simplifies all that price action, but all of that variation says there was a lot of stretch away from it. That tends to cause the RL10 to slow down. But the RL30 just looks at this as noise and smooths that all out. So on really good moves, the RL10, yes, will reverse and move up, and the RL30 will lag a little bit, but it finally curls up, and then there will come a time, which we call like leg 1 and leg 2, somewhere after leg 1, you will get the RL30 ends up crossing over, and then until the in the second leg, the RL10 begins to stall. And all that is mathematics. It's the mathematics of regression lines and variation in price, and the fact that the RL30 is smooth. It doesn't react to the decay of price action as fast as the RL10, so it lingers and stays higher for longer than the RL10. In the same way, if we looked at the RL90 would have been even slower to turn, and it too would take longer to curl. So there will come some time when the RL90 crosses the RL30, and then it will be the highest. And that's just the simple mathematics of regression lines. The last thing I want to say is, why do you call these moving regression lines? I should have described that earlier. So when we say the price action is here, and then we draw the regression line that minimizes the error in that last time frame right here, that's the high of the bar and that's the low of the bar. And maybe that's where the close was, right there. The 10-period regression line puts a dot that would be the perfect price in this yellow dot right here. That would be the perfect price in that bar as predicted by the regression line. So now the next bar gets drawn. It opens here. Oops, let me draw it in black. It opens here and then maybe sells off and then goes here. So we dropped the last bar and now we added a new bar. So we got rid of last bar. Now we still have 10. Now when I draw that regression line, and I'm going to draw it in purple, it has to account for all of this extra price action that came down. So the new regression line is going to look something like this, not as steeply up as the blue regression line. And the new price action is going to be there at the end point of that regression line. So what the moving regression line, these two regression lines here, the blue one and the purple one, those are straight line 10-period regression lines that terminate in that perfectly predicted price. Now, if I keep doing that, I may end up getting this regression line here. And so what the moving regression line does is it takes each of those endpoints of the daily 10-period regression line, and it starts just plotting those and then connects that with what appears to be a moving line. So that's why the moving regression line is really the curved line that connects all of those endpoints of each subsequent 30-period regression line. So it creates the appearance of a smoothly flowing line. And this is called a moving regression line. It's known as a least squares moving average in the technical literature because it uses the least squares method to compute that moving line. It's a least squares method. Whereas if I looked at a simple moving average, it simply takes the average price of the last 30 bars and takes the average and it creates a simplified moving average. So a simple moving average is a type of moving average. An exponential moving average uses some other mathematics to compute the shape of the line. Moving regression line moving average uses the least squares moving average to compute that regression line. Now, one of the things that you notice is that the least squares method is much more adaptive than the simple or even the exponential. In fact, of all of the standard moving average methods, the least squares moving average is the most adaptive. It is the quickest to react to significant changes in the direction of price. And here's how I can show you that that is true. On this chart for IYR, there's actually four moving averages. And I'm going to color code them. There is the 10-period, the RL10, the moving regression line 10, and that's this one, which for convenience sake, we color code with the MACD. And I'm going to compare that to the simple moving average 10, which in this case is the center line of this dragon. So this dragon is a 10-period Bollinger Band plus or minus a half, which means that it finds a simple moving average. That's the center line, which we call the spine of the dragon. And then it puts a plus or minus half a Bollinger Band around it. Now notice that it is slower than the 10-period moving average. I'm going to show you that in red. This was the turning point of the RL10. This was the turning point of the SMA10. This was 1, 2, 3 bars later. The RL or the simple moving average 10 turned after this. So the RL10 is 3 bars sooner, and it stays closer. Look how close it is to price. I'm drawing the price in red so you can see it. Look how quickly the RL10 adapted to that. And when price made this turn, the RL10 was quickly to turn, but the slow simple moving average 10 never even detected that little piece of action. So it's oversimplified and it's slower, but it is smooth. Look how smoothly it turns, but notice that it turns after the RL10 turned. So the RL10 is much faster than the simple moving average 10, which is slower. Check or hold. Now, the next two that I'm going to show is in red, I'm going to show you the simple moving average 30, which is this dashed red line. Look how slow that is to move. And I'm going to compare that to the simple 10, which was the middle of that dragon. Look, now the 10-period simple moving average is much faster and stays closer to price than the red line. So the dragon turned here pretty quickly. The 30-period moving average turned in this area, and it took many bars to turn, and it was 1, 2, 3, 4, maybe even five time periods later compared to the turning point. And then up here, this is where the simple moving average 30 turned, and then the simple moving average 10 turned right here. But this is where the RL10 turned. Now, the last one that we're going to show is the RL30, and that's the simple moving average 30. This is where it turned. The RL30 turned at the same place that the simple moving average 10 turned. So even though it's using 30 data points, it is as fast as the 10 simple moving average. So it's as fast as the 30, but but notice that the RL30 stays closer to price than the 10. So there's a lot of goodness in that. So when I look at the 10-period and the 30-period look backs, I can use a simple moving average, and I can use the regression line moving average, also known as the least squares moving average. So when I compare the simple moving average 10 to the RL10, the RL10 is fast, and the simple moving average 10 is slow. But when I compare the simple moving average 10 against the simple moving average 30, the simple moving average 10 is fast, and the simple moving average 30 is slow. When I compare the RL10 to the RL30, the RL10 is fast, and the RL30 is slow. When I compare the RL30 to the SMA30, and that's the difference between this black line and the red line, simple moving average is slow, the 30 moving average is fast, and then you can see that compared to the turning points, the simple moving average and the RL30 are they turn at about the same time. So from just those 4 moving averages, we can actually get some interesting comparisons over, if we're interested just in the last 10 bars, we can compare the SMA 10 to the RL 10. If we want to look at 30, we can look at the SMA 30 and the RL 30 to get a slow and a fast. If we want to compare fast time frame or recent time frame against long time frame, we can compare RL10 against RL30 or SMA 10 against SMA 30. So those understanding those 4 regression lines and how they work together allow us to detect these very important turning points in the trends soon enough that we can get good entries here and good exits here and not have to wait until the simple moving average reverses. And why is that important? Because if you wait for a lagging indicator like the simple moving average to have turned, my price has already moved up to here. And that means I get my signal here, but I get this price level for my entry. My entry is way too late. So if I use the slow moving average, my entry is here. Whereas if I use the fast 10 period moving average turning point, when it crosses the dragon and the peace R flips, I'm getting a price entry here. And now I would rather enter here rather than here. I'd rather have entry 1 rather than entry 2 because I now get all of those extra gains. And now look what happens. My risk box here is small because I'm close to the turning point. Because if price fails through there, I'm going to be short in a collapsing dragon, our favorite pattern. But if I can get the earlier entry here, my risk box is here. And let's just pretend that's $1. So if I can risk $100 and my risk is $1 per share, I can get 100 shares. Whereas if my entry is here, my risk box looks like this. My risk is 1, 2, 3. My risk is now 3. And so now I can only get 33 shares on this entry. I can only get 33 shares. And then my exit up here on trade number 1, I get the move from here all the way up to here. Let me color that in purple. I get this whole gain from my entry here to my exit there divided by 1 unit of risk. As we saw before, I get 7R, meaning that on my 100 shares, I made $700 because I risked $1 a share. But on my 33 shares, I get my entry here. I only get $3 per share times 33 shares. I only make $100 because it's only a 1R trade. So the reason to be interested in getting the earliest manageable entry is that you simultaneously have a smaller unit of risk and you get the advantage of early moving and you get a larger R multiple and a larger capture of dollars per share. That is characteristic of the style of trading that we employ. That's everything that I wanted to say about Brian's question. And it kind of talks in a more general way about our general strategy for finding trades. When we see a trade that has turned at this turning point, we are typically going to use our filters to find a compound critical state. Compound critical state. And to say thanks to John for hanging in there, the EdgeRater software that you are familiar with from Chris White. Chris White is the data wrangler at EdgeRater. We built 3 templates for his software, which is used to find charts. One of them is for this, I think is one of them. Yeah, well, one of them is for the sniper. And what the sniper does, it finds 5 patterns of different types, all of which are geared to finding a particular price pattern that we consider to be like this, a compound critical state. Now, you guys that have been listening along in other lessons know about the Godzilla, the catfish, the fireworks, the fence sitter. Those are all named patterns in the sniper. Each one of them is a compound critical state, which means that from that tightly compressed wrist box, there's a greater than normal chance of getting a large upward move or a large downward move in short periods of time. So you get an explosive move in either direction for a small unit of risk. And since we don't have a directional bias, we can follow price wherever it leads. And now we have an opportunity to make money in the market in either direction. Oh, by the way, if you're an options trader, you can also do straddles on that. And that's another lesson for another day and the options course. So for John's edification, in the EdgeRater software that you have, you will find templates that look for 5 different patterns that meet the criteria of a compound critical state, which give you the opportunity to benefit from big moves like this one in IYR. Okay. So that's and I would say for the other guys within the sound of my voice, Chris White sells that EdgeRater software for $2,000 for a lifetime license. And you pay a small monthly fee for good data source for current data. There's a subscription service for that. It needs a data source to do that. It's pretty inexpensive. But if you are a Tortoise member, you can get that for $1,000 off and for that lifetime license. And it gives you a way to do back testing and automatic trade framing. And plus the EdgeRater software has a bunch of other templates and things that it can do for back testing as well. But for the Tortoise traders, the particular item of interest is that it does have a template for sniper trades. The other 2 templates are our auto framer, and one template is for the Dow 30 and one is for ETFs. And what that does is looks for our mechanical swing systems and the auto framer to find good trades. So as a simplified way of finding targets, that's not a bad, and I should say, I don't get any money for referring you there. You get $1,000 off. Money that I make as a coach and as a teacher is from providing explanations and inventing new systems and offering courses and all that stuff. So I'm not trying to push his software for a financial reason. I feel necessary to say that. Okay. Any final questions from the team? I have us at 8 o'clock and I need to get back in and crank the reports at 9:30 tonight. And 90 minutes from now, we will do the nightly strategy podcast for Friday nights. So I'm open to any questions that you may have. You can put them in the chat or by microphone if you have any. I have about 10 minutes before I gotta run.
Can I ask you a question, Ken? If we're trading, with the, focusing on the RL30 and PSAR and Dragon.
Yeah.
is it important or really necessary to have the RL30 on the chart?
I
If you-
do. I put
if-
it on there for the following reason.
Okay,
Because if you're using the owl pattern, now if you remember the supported spring crossing, I'm going to circle where that entry occurs. The supported spring crossing occurs right here. When price, which had been going down, at the RL10 turns, it crosses the dragon and crosses the PSAR. So there's like 3 criteria for an SSC. Okay. You have to have a harsh winter. You have to have a turn in the RL10, and you have to have the RLXD, regression line crosses the dragon. And we typically see that that occurs when price takes out the PSAR. So those 3 criteria give you a supported spring crossing. Check or hold?
yeah,
And we draw the risk box to the bottom point of the RL10. So that's where, and that's also where the PSAR flips to as it starts to go up. So that becomes our 1 unit of risk. Now, the owl pattern requires criteria 4. The dragon has to have turned. The dragon was down because it was a harsh winter. The dragon was sloping down and it reverses. And then the RL30 has to go from downward slope to upward slope. So those 2 criteria make you wait a little bit longer. And usually it's the RL30 is the last one to turn. In this case, this is a poorly chosen example. The RL30 is right here. It slopes up like right about here. So your entry for the owl would actually be right about here. But what that does is that extra 2 bars gives you a little bit more confirmation that the move is still going up. So your owl entry on this chart would be right here. So if you don't draw the RL30, you don't see the owl. And so some guys are owl pattern traders. The other thing I want to show you is that if we're going to compare the RL30 to the SMA 30, we notice that the RL lines for a given time frame vary quite a bit. The simple moving average lags a little bit, and it doesn't vary quite as far. It goes like this, and then goes like that. So the maximum excursion of the simple moving averages are only that much. Check or hold? But for the regression lines, they make a wider channel. All right. So what that means is when there's a harsh winter and price is going down fast and then price reverses, well, the RL10 will turn fast. We know that. Then the RL30 will change. And then the simple moving average 30 will change. Check or hold?
so it's a matter of whether or not you want to wait for the additional confirmation.
Yeah.
for
So
the
there's a little
RL30.
there's a time lag in there. And the other point is that there's a distance between, the RL30 travels further than the simple moving average. So when the RL30 reverses, when it crosses back above the other moving average, this is like a confirmation that this thing that was horrible has now reversed enough that it has crossed the slower moving average, and now this is all double plus good. That occurs. I'm going to draw that on this actual chart now. Here is our thickened RL30. That's where it turns. And our simple moving average 30, which is the middle of the river, that's the middle of that 30 period Bollinger Band, is here, and now it starts to roll up. But notice that when the RL30 crosses over the simple moving average 30, that's like a confirmation that the upward move is robust, because now the simple moving average, which is the health of the trend, that's the end of the trend. This was the start of the new trend as measured by the RL30. And then the simple moving average is a lagging confirmation. Now, notice that after the RL30 rolls over, there's a period of time all the way out to here before the SMA 30 rolls over. So you could get out of their trade here instead of down here. And the RL30 starts decaying here, and now it's warning, 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 warning. Officially, this is where I pick up a negative bias. This is where officially I pick up a positive bias, because the RL30 is above, I should draw that as green, as good. Now I have a positive bias all the way through here until the RL30 goes underneath the SMA 30. Now I have a negative bias in here. Do you see that? And now recently, because just a few days ago, it crossed over here, I now have a positive bias on symbol IYR. That negative bias didn't last very long. And in fact, the SMA 30 has already started to curl up again. And the RL30, it rolled over here, went below the SMA 30, went to here, it reversed right about, and it started to narrow the gap. That little window of opportunity narrowed until it crossed here, and now it's rolling up.
So I
You
guess
see?
some of it depends on what kind of trader you are, but also if you're trading off the R10, once that
That's right.
R30 has given you
So
that
here's how
confirmation, you
I
might be
yeah,
more confident in your reentries.
exactly.
Okay.
Exactly. So what I like to do is I like to enter in here with the RL10 and the SSC. But now each one of these little moments look like signposts. They're like little road signs that tell me, yeah, I'm making progress. And these are all little technical indicators that it's still working. And then up in here, where the RL10 rolls over, that's a signpost that says the aggressive move is over. And in fact, price began to decay all the way through here. Now I'm just drawing price in blue. That was all price delay. So this is a really good signpost when the RL10 turns. So I can be an aggressive trader by trading from the R10 to the R10. But what's the cost of that? The cost of that is that because this is so early after a horrible, harsh winter, this trade fails more often than one that is slower like an owl. But the payoff is that I get a better reward to risk ratio and I get in sooner. And if this fails, I'm more quickly into a collapsing dragon. So when you're putting together your dashboard and your management indicators, you got to decide how many indicators you want to put on there. I personally find this particular array, I call this my simplified sniper, because that gives me a set of trading indicators to find turning points. And now notice where the PSAR flips are occurring. That's why the PSAR's on there. because that's what my exit is. So when price is cruising up and then it rolls over and hits the PSAR, I'm out.
On that particular chart, the RL10 rolled over a number of times and price came back into the dragon.
Yeah,
If you
it
were
came,
exiting there though,
that's right.
with the way that the RL30 was still moving up, it
Yeah.
would give you additional
Yeah.
confidence in your
That's right. So if I want to stay a little bit longer, like if I just want this to be one trade, look how nice the RL30 is telling me, hey, buddy, this is a very healthy trend until that turns over. And that's the wisdom of the owl. Whereas if I had had a large position, as soon as that RL10 rolled over and I took the exit, I would end up entering here and exiting here and re-entering here and then exiting here.
Right.
And now I end up getting this in about 4 segments if I'm using the RL10 and the skin of the dragon.
Is there
But if
anything
I
wrong
want a
with
little
doing
bit,
that?
yeah, if I want a slower, smoother trade, I might be interested now in the slope of the RL30 as my guide.
So once you make it past those first two pullbacks, maybe you say, okay,
Yeah.
now that I've got some profit in the trade, I'll
Yeah.
look at the RL30 and maybe let that
Yeah, so
have.
I think of this as leg 1 and leg 2, and
Yeah.
it keeps going. If this was going to fail, it's usually after leg 2, which is for me about a 2-hour trade. So I actually don't mind treating that as a 2-leg trade. And on the longer time frame, maybe that's leg 1 and that's leg 2. So this thing actually had 4 little frog hops. But during that entire period, the RL30 remained positive. And remember, where the RL30 crossed the simple moving average, 30, remember that the Bollinger Band mean is kind of the long-term fair value of the trend. So this is where the RL30 SMA 30 analysis tells you that's your envelope of abnormal gains, if I can say it that way. During this period of time when the RL30 is above the SMA 30 and they're both rising, you cannot get more bullish than that. Okay?
Okay. So you might
But
have got a couple re-entries on the first 2 legs, but after
Yeah.
that, with everything moving, you say, I'm going to give it more leeway. I've got profit now.
Yeah.
I'll let it. Okay. I'll give it more
Exactly.
room.
Because remember, if I'm getting long right here, I'm actually getting long before the official
Yeah.
bullish,
Yeah.
I'm actually getting this like, hey, within 2 bars, I'm already here. I've got almost 2R in 2 bars. How much more did I want to get? You know what I mean?
Yeah.
Because I don't mind actually exiting here and then re-entering here if I'm being an aggressive trader. And then I get this move. Because this rolled over, I might have exited here. And then when it didn't fail, I end up re-entering here. And then I exit probably here. Oops.
Yeah. Yeah.
Yeah. So as you study, and this is my point about where you spend your time studying is in the management of exits and re-entry decisions. So I'm showing the successful trades here in purple. Okay.
So maybe by the time you get to that third one and the RL30 is really going, you might say, I'm not going to take this exit. I'll give it a little
That's
bit
right.
more room.
That's
And
where I say, hey, look, I've
okay.
actually got some markets money.
Yeah.
I've got from my first entry. Remember, my first entry was my seed capital. But if I cashed 1R here and then I re-entered and I cashed another R, now I'm at plus 2R. Whether I got that as one trade or 2 short segments, I'm up a couple R. So maybe this is with maybe I put one of those in the bank and one of them I bring over and say, I'm going to use markets money and be more relaxed. And now instead of exiting here, I add a second position here. And now I've got two trades going.
Okay.
And now when this whole thing rolls over, I get out of a double scoop position and now I get 4R instead of 2R.
Okay.
Aha. So one of the reasons to have the longer term indicators on there is it starts reminding you. Oh, look at this. It just happened to have a very nice flashcard on that. If I can get in there and find it. Oh, it's not gonna let me snag it. If I could expand that, I would. But what this shows is that when I frame that first trade with a R10, there's really a range stat of +9 boxes up. And so my usual trade might just be +1, 2, 3R trade. That actually represents one leg of the next higher time frame. And that's his second leg, which is trades 4, 5, and 6 of my tactical trade. And then this is the third leg up is 7, 8, and 9. And maybe all of that is one leg of 2 time frames higher. But most of the time, after a harsh winter, you get a little bump and then it fails and keeps going. So that's why I don't believe in that trade. I just follow the price.
Okay.
So we have to remember, if we're using the RL10 as our primary guide for entry and the RL30 for confirmation, remember, if we go up one time frame from a 3-minute bar to a 10-minute bar, this RL30 on our bar, on our chart, is what the RL10 looks like on the 10-minute chart. So you can actually see the higher time frames RL10 by looking at the RL30 on this time frame. That's what we mean by fractal. And so when you see me looking at the 10, the 30, the 90, and the 270, those are all multiples of 3. I'm really looking at the RL10 of the next time frame, 2 time frames, and 3 time frames. So on one chart, I can feel what the market price and the market mood is like on those higher time frames without changing my chart. Check or hold.
Yeah. Got it.
And if you look at the regression line fractal framework, that uses those 4 regression lines in a logical fashion to find compound critical states and estimate fair value. That's another lesson for another day.
Okay. Thank you.
So that's the short answer. Why do I have those extra pieces? Because it helps me see multiple time frames. And I find that when I look at that, it keeps me from getting too agitated about the immediate tactical noise of price in the RL10. I can get a little standoff and I can be a little calmer and let things play out a little more if that's called for.
That makes sense.
Okay.
Okay, great. Thank you.
Okay. There we are. Hey, John R., thanks for being here. Tell your friends from Edge Raider Land, and I'm willing to put together some courses for all our new Edge Raider fans. I've talked with Chris White about that, and we're actually designing some courses to help you take our tactical trade management techniques, combine it with the templates that are in Edge Raider to help you guys see some of the nuances that we just covered in this lesson.
That
If that
would be
makes sense.
fantastic. Thank you very much.
Hey, you're very welcome, John R. Thanks a lot. And we'll see all you guys a little bit later, maybe at 9:30 Central Time in about an hour is when I normally do that's when I will do the standard evening strategy report where I took a look at the trades for the day and then the daily and weekend reports for the next setups for next week. All right, guys, that's all I got for tonight for this session. I will get this recording posted into the foundations course in the usual spot for further review. And then John R., if you would send me an email to Long KE, my email is longke@yahoo.com. If you send me an email, I'll send you a link to a recording of this session. I'm probably going to send it to Chris as well, in case he wants to send it to the EdgeRaider community. But because you suffered through this lesson,
Thank
and
you very much.
we're
Will
a good
do.
sport. You're a good sport. And so I'll send you a link to this recording, and you are free to share that if you want. Okay?
Very good. Have a good night.
All
Thanks
right.
again.
Cheers, guys.